Mark, and today on Outside Views, I want to talk a bit more about the trade negotiations between the UK and Switzerland after Brexit. According to a UK government press release, Switzerland and the UK started negotiations on a modern free trade agreement this month. The progressive approach, as they put it, aims to promote new digital and electronic opportunities that did not exist 50 years ago when the trade agreement was originally signed. With Switzerland being the UK's 10th largest trading partner, the free trade agreement should further boost trade between those two countries. For the pharmaceutical sector and the entire field of life sciences, this step should further promote the exchange of research and innovation topics. A so-called mutual recognition agreement in this area, signed back in 2022, already includes science and technology collaboration. The British Pharmaceutical Industry Association, ABPI, has hailed the free trade agreement negotiations as a crucial opportunity for a world-leading deal between two life science superpowers. Yeah, we know this kind of language. In February 2019, the UK and Switzerland signed the UK-Switzerland Trade Agreement, which forms the basis of the current trading relationship. It's a continuity trade agreement which replicates as far as possible the trade arrangements between Switzerland and the EU, so copy and paste. And this agreement provides a platform from which they now try to begin the process of negotiating a new and more ambitious trade deal. Switzerland is already one of the UK's most important trading partners, and as a close European neighbour, it is a key market for UK businesses of all sizes. Total trade between the UK and Switzerland was worth £52.8 billion in 22. And as I said, Switzerland is also the UK's 10th largest trading partner worldwide, and their third largest services trading partner after the EU and the United States. A new FTA offers a unique opportunity to enhance trade and investment between both countries and open up new opportunities for growth in the UK if it works. Although there are high levels of service trade between both countries, there is no comprehensive agreement on trade and services to replicate. However, in 2020, the UK and Switzerland secured the Services Mobility Agreement, which allows UK professionals to work in Switzerland for up to 90 days without a work permit. This came into force on January 1st in 2021 and is set to expire on December 31st in 2025. In 22, the UK and Switzerland signed the Mutual Recognition Agreement I mentioned earlier for goods, which was applied provisionally from January 1st in 23. This applies to a specific set of goods which, when tested in the UK against Swiss regulations, can be sold in Switzerland without additional testing in Switzerland, but they still have to do it beforehand. Trade between the UK and Switzerland has tripled over the past 20 years, reaching over 50 billion a year in 22. The current agreement is made up of a complex web of smaller agreements that have built up over 45 years between Switzerland and the EU in reality. And these agreements focus mainly on trade in goods and not services, which represent almost half of the trade with Switzerland. Renegotiations provide an opportunity to expand the agreement to cover a broader number of key areas of shared strength, including services, investment, digital, and the environment. Increasing opportunities for services and investment are a goal for the UK here. And there are significant opportunities to increase trade and services and investment, and which would be a driver of economic growth in the UK. With services representing over 70% of GDP for both countries, the UK has much to gain from extending the agreement to cover services. In 22, services trade with Switzerland was worth £23.7 billion, and Switzerland was the 8th largest direct investor into the UK, with a total stock of Swiss foreign direct investment worth £74 billion. Switzerland was also the 9th largest destination for UK outward investments in 21, with £52 billion. And despite this, the current FTA has no services or investment coverage. Instead, services and investment trade between the UK and Switzerland takes place on general agreement on trade and services terms, which represent the minimum baseline for World Trade Organization, so WTO signatories. This offers no preferential access for UK businesses or investors to Swiss markets. The exception is business mobility, where the UK and Switzerland have agreed enhanced business mobility arrangements through the earlier mentioned Services Mobility Agreement. The United Kingdom currently trades with Switzerland under the UK-Switzerland Trade Agreement I mentioned, which came into force on January 1st in 21. This agreement indeed replicates these existing trade agreements between the European Union and Switzerland as far as possible, but not completely. And there is no single comprehensive trade agreement between the EU and Switzerland because the Swiss failed to comply with what was necessary there. And these agreements focus mainly on trade in goods, whilst also addressing some other areas such as government procurement. And so they couldn't replicate a comprehensive agreement here, and so they had to secure their Services Mobility Agreement. And that indeed allows UK professionals to work in Switzerland for up to 90 days without a work permit. And this thing is to expire fast, and so they have to work on another one now. And that's why in 22 they signed the Mutual Recognition Agreement on goods, but this just applied provisionally since January 1st. And it only applies to a specific set of goods, and they need to be tested under the observation of Swiss regulations, as I said before. Otherwise, they cannot be sent to Switzerland. The Department for Business and Trade is preparing for negotiations to upgrade the current set of agreements to, a full comprehensive trade agreement. It will be adapted to build on the strengths of the UK and Switzerland, focusing on areas not significantly covered by the existing agreement, and that means services, mobility, and investment. A new agreement with Switzerland, well, they expect that this will present new opportunities in the service sectors, but also in the financial services, professional and business services, digital services, and new opportunities in goods trade through open market access and simplified rules of origin and customs. As a member of the European Free Trade Association, EFTA, Switzerland has normally concluded FTAs together with Norway, Iceland, and Liechtenstein. In 21, the UK signed an agreement with Norway, Iceland, and Liechtenstein, that's the EEA EFTA states. Switzerland can negotiate bilateral agreements outside of this framework, as they did in the case of agreements with Japan and China. But they always have to keep in mind what it does to their trade with the EU. Trade between the UK and Switzerland has indeed quadrupled over the past 20 years, and the current agreement still focuses on goods. And so they will have to do something if they want to do more in Switzerland in the areas of services. Renegotiations provide an opportunity to lock in existing benefits and expand to cover a broader number of key areas of shared strength, including services, digital and data, and the environment. As services represent over 70% of GDP for both, as I said earlier, the UK and Switzerland have much to gain from enhancing the current agreement. But there are also some dangers. And these agreements do not include service provisions yet, but they are nearly half of the bilateral trade in services. And they want to remove non-tariff barriers and support further growth in these areas. And they want to embed and build on existing arrangements under this Service Mobility Agreement to facilitate the movement of skilled business persons and make it easier to deliver services in both countries. In 2019, there were an estimated 383,000 business visits from the UK to Switzerland and 29,000 visits in the other direction. The deal could support trade, but it always depends on how far the Swiss are willing to go. But there is an opportunity to negotiate the reduction or removal of existing tariffs on agricultural goods not covered by the current trade agreement, because that would be harmful for the EU, and I don't know if the British really want that. They currently pay about £7.4 million in duties at the moment. There are tariffs on red meat, chocolate, and baked goods, which are very high at the moment, with businesses describing them as a key barrier to trade. But does Switzerland really need chocolate? But as I said earlier, Switzerland is a big investment partner, and so even their investments in textiles, chemicals, manufacturing, and especially financial services are, of course, of interest for the City of London. But once again, I have to say that this is really a lot just on financial services here again. Of course, financial services bring a lot of money into the UK, but the benefits gained from this go to a certain group of people. And we talked about this group of people since the Brexit campaign, because they are the ones that profit from Brexit, and they are the only ones that profit from Brexit. That's why they put a lot of money into Brexit, although they overlooked a few things like euro clearing and stuff like that when they campaigned for Brexit. But would this agreement, in areas where the EU doesn't have agreements with Switzerland for good reasons, would this agreement be good for the average British citizen? That is a question everyone will have to ask. But I'll keep you informed about those negotiations when they proceed, and we will see what the outcome of this will be. And I'll see you in my next video. I'll be back.